Welcome to the deep dive. Today, we're really going behind the scenes, aren't we?
We are, looking past the usual headlines.
Exactly. We want to get into the actual plumbing of global finance. The specialized financial markets that sit underneath almost everything.
Yeah, things like your mortgage rate, international trade, it all connects back to these markets.
They're huge, incredibly complex, and honestly, often pretty invisible to most people. But trillions, literally trillions, move through them every single day.
That's right. So our goal today is to give you a clear picture, a structured look at the five main types.
We'll break down what they do, who the key players are, and crucially, one really critical feature for each that, makes it tick.
It's about getting beyond the buzzwords, understanding the actual machinery.
Okay, so where do we start? Maybe with the absolute basics. What is a market?
Good place to start. I mean, fundamentally, it's any group of people, anywhere, trading something, a product, a service. It could be physical, could be digital.
And the core idea is buyers and sellers finding a middle ground on price.
Exactly, that compromise point, the equilibrium price. That's the heart of it.
And this basic principle, supply and demand, it still drives everything, even in these super sophisticated financial arenas.
Oh, absolutely. Think about the global gas market back in 2021, 2022. That wasn't some abstract theory playing out.
No, that felt very real. Prices went crazy.
Right. You had the Russian invasion, the sanctions that followed, Europe's storage issues, a cold winter, and then suddenly this surge in demand from Asia.
A perfect storm, really.
It was a massive supply shock hitting increased demand, so prices had to go up. Scarcity and desire, that's what sets the price, whether it's gas or, complex financial instruments.
Okay, so let's try and bring some structure to all this complexity. You mentioned classifying them.
Yeah, a useful way to start is thinking about the duration of the funding involved. Are we talking short-term cash needs or long-term investment?
That makes sense.
So broadly, we split them into two main types. First, you've got money markets. These are all about the ultra short term.
Like really short.
Yeah, think hours, days, maybe a few weeks. It's where big institutions basically shuffle cash around to manage their immediate liquidity needs, overnight borrowing, that kind of thing.
Okay, short-term liquidity. And the second type.
That's the capital markets. This is the other end of the scale. We're talking long-term financing, years, decades, sometimes even with no fixed end date.
Right, for funding the big stuff.
Exactly. Huge infrastructure projects, companies expanding, major investments. That's capital markets.
Okay, money markets for short-term cash, capital markets for long-term funding. Got it.
Mm-hmm.
Let's dive into the first specific market then, a crucial money market, the interbank market.
Right, the interbank market. You could call it the system's liquidity adjuster. It's absolutely fundamental.
So what's happening there day to day?
Well, you've got banks and other huge financial institutions, over 400 of them, involved lending and borrowing massive amounts of money between themselves.
Big sums.
Huge, wholesale amounts. And importantly, it's typically unsecured.
Unsecured. Wow. So it's based purely on trust between these institutions.
Pretty much, yeah. And it's very short term, as we said, mostly overnight, sometimes up to maybe 3 months. They're constantly using this market to make sure they have the right amount of cash on hand, meeting regulatory requirements, that sort of thing.
And the interest rate they charge each other for this borrowing, that's become a really big deal recently, hasn't it? There was a major change.
A massive change. One of the biggest shifts in modern finance, really. We absolutely have to talk about the move away from Libor.
Ah, yes, Libor. The London Interbank Offered Rate. That name rings a bell. And not always for good reasons.
No, unfortunately not. Libor got completely bogged down in scandal. The fundamental problem was that it was based on what banks said they would lend at, not what they actually lent at.
So it was open to manipulation.
Exactly. And this wasn't some minor benchmark. It underpinned trillions and trillions of dollars worth of financial products globally. Mortgages, loans, derivatives. Its failure was a huge blow to confidence in the system.
So it had to go. What replaced it in the UK? And crucially, why is the new system better, more trustworthy?
In the UK, the main replacement is Sonia. That's the Sterling Overnight Index Average. And the critical difference, the key feature here, is that Sonia is based on the interest rates from actual overnight wholesale transactions that have already happened.
Ah, so it's based on real data, not quotes.
Precisely. It moves the benchmark from a hypothetical guess to a measurable, observable fact. That rebuilds trust because it's seen as much, much closer to a genuine risk-free rate for that very short-term lending. It reflects reality.
That makes a lot of sense. Okay, so from that short-term vital liquidity adjustment in the interbank market, let's switch gears to the long-term capital markets. First up, the bond market.
Right, the bond market.
Right.
You could call it the debt lifeline for governments and big companies.
Why a lifeline?
Well, governments often spend more than they take in taxes, right? They run deficits. They need to borrow money to cover that, and also sometimes to influence the amount of cash flowing through the economy.
And
Companies use it to fund major investments, new factories, research, big long-term projects. They issue bonds, which is essentially an IOU, promising to pay back the investors' money over a set period with interest.
So it's a core way to raise long-term debt finance.
Exactly. It's a capital market function.
Now, the price instability here, it all seems to hang on how risky the borrower is perceived to be, right? How likely they are to pay the money back. This is where credit ratings come in.
Yes. Credit rating agencies like S&P Global, Moody's, Fitch play a huge role. They assess the risk and give the issuer a grade.
Like AAA is super safe, down to D for default.
Yeah. You have investment grade, that's AAA down to BBB, generally seen as stable, lower risk. Then below that, BB down to D. That's often called junk or high yield territory, much more sensitive to economic conditions, higher risk of default.
Okay, so the rating matters. But you mentioned before we started, for people who follow finance closely, there's maybe a bigger structural force at play right now than just individual company ratings, something about central banks.
That's right. I mean, the basic principle holds. If a company's situation worsens, its rating might get downgraded, say, from A to BBB, investors will then demand a higher interest rate, a higher yield, to compensate for that extra risk.
And that makes the price of their existing bonds fall because the old interest rate isn't attractive anymore.
Correct. That's fundamental risk pricing. But the really big structural factor, especially over the last decade or so, has been the actions of central banks themselves, specifically quantitative easing, or QE, and now quantitative tightening, or QT.
Ah, QE and QT. Can you unpack that a bit in the context of bonds?
Sure. Under QE, central banks were buying massive amounts of government bonds, and sometimes corporate bonds, too. They became the biggest buyer in the market by far.
Which pushed bond prices up and yields down, right? Because there was so much demand.
Exactly. It artificially suppressed yields. Now, with QT, they're doing the opposite. They've either stopped buying, or in some cases, they're actively selling those bonds back into the market.
Which floods the market with supply.
Right. And that fundamentally changes the supply-demand balance. It pushes prices down and yields up, and it also sucks liquidity out of the system. This expansion and contraction by central banks, that's arguably a far bigger driver of overall bond market conditions and risk appetite right now than any single company getting downgraded. It's a huge systemic force.
Yeah, fascinating. So central bank actions are really reshaping that long-term debt landscape. Let's contrast that debt market with the other major capital market.
Right.
The equity market.
The ownership market.
Yes, the equity market or stock market. This is where public limited companies raise capital, but instead of borrowing, they sell shares, tiny pieces of ownership in the company itself.
And unlike bonds, there's usually no fixed repayment date, is there?
Generally, no. You're buying a stake in the company's future fortunes, hoping its value grows and maybe it pays dividends. It's truly long-term capital for the business.
So what's the critical structural feature we should focus on here? You mentioned primary and secondary markets earlier. Exactly. That distinction is key. The primary market is where new shares are issued by the company to raise fresh capital. The most famous example is an initial public offering, an IPO or flotation.
That's when a private company first sells shares to the public, right? To raise money directly.
Correct. That's new money flowing into the company. But, and this is the crucial point, the vast, vast majority of daily trading activity happens in the secondary market.
Which is just investors trading existing shares amongst themselves on exchanges like the London Stock Exchange or the New York Stock Exchange.
Precisely. The company itself isn't directly involved in those secondary trades. The money just changes hands between investors.
Okay, so why is that secondary trading, just swapping existing shares, so vital?
Here's the core insight. The secondary market has to be deep, active, and liquid, meaning easy to buy and sell shares quickly for the primary market to even function effectively.
Why? How does trading old shares help companies raise new money?
Think about it from an investor's point of view. Would you risk buying shares in an IPO, giving a company your money, if you weren't confident you could sell those shares easily later on if you needed to?
Probably not. You'd want an exit route.
Exactly. The thriving secondary market provides that exit route, that assurance. It guarantees liquidity. Knowing you can sell reasonably quickly at a fair price makes investors willing to take the risk of buying in the primary market in the first place. So the health and liquidity of the secondary market is the absolute bedrock that allows companies to raise new equity capital. They are completely interdependent.
Liquidity again. It seems to be a theme. Okay, market number 4. Let's go global. The foreign exchange or FX market, the international connector.
The biggest market on the planet by volume, actually, and yes, absolutely essential whenever money needs to cross a border. Its primary function is simply allowing currencies to be exchanged.
Who are the main players here?
It's dominated by major global banks. Central banks played a role too, and other large financial institutions. They trade for their own accounts, but also, crucially, on behalf of their customers, importers, exporters, investors.
And what drives the demand for swapping, say, pounds for dollars or euros for yen?
Well, there are three main drivers. First, just international trade in goods and services. If a UK company buys parts from Germany, they need euros. Second, short-term investment flows money chasing the best interest rates around the world. If US rates are higher, capital might flow there, needing dollars.
Okay. And the third?
Long-term investment. Buying shares in a foreign company or a multinational setting up a factory abroad. That requires buying the local currency.
Now, one thing you often hear is that FX isn't really a borrowing or lending market like, say, the bond market. What's the significant insight behind that distinction? What makes FX structurally unique?
You're right, the core function isn't borrowing or lending, but the really profound structural difference, I think, is that it's overwhelmingly an over-the-counter OTC market.
OTC, meaning not on a centralized exchange.
Exactly. Unlike, say, the London Stock Exchange with a single building and a central order book, the FX market is decentralized. It's a vast global network of banks and dealers trading directly with each other 24 hours a day, 5 days a week. There's no single physical location, no single price feed.
Wow. So how does that decentralization affect how it actually works?
It makes things like speed and communication absolutely critical. High-frequency trading algorithms, or HFT, play a massive role. They try to exploit tiny price differences that might exist momentarily between different dealers in London, New York, and Tokyo.
Latency, the delay in information becomes key.
Hugely important. When a major piece of news breaks, say a central bank announcement, the press adjustment isn't instant everywhere. It takes fractions of a second to ripple through that decentralized network of bilateral agreements. Those tiny delays, those temporary pricing differences, are what HFT algorithms try to capture. So the lack of a central clearing point actually drives a lot of the short-term trading volume and volatility, especially when unexpected events happen.
A truly global, high-speed, decentralized web. Okay, on to our fifth and final specialized market. This one deals purely with risk and uncertainty, insurance and reinsurance.
Yes, the risk transfer system. Its basic function is pretty familiar, I think. Individuals, like you buying car insurance or companies buying liability cover, pay a fee, a premium.
And in return?
In return, the insurer promises to compensate them financially if a specific bad event happens, a car crash, a fire, a lawsuit. You're transferring the financial risk of that event to the insurer.
Straightforward enough. But there's a crucial layer behind this, isn't there? Reinsurance. What's that about?
Reinsurance is essentially insurance for insurance companies. It's absolutely fundamental to the stability of the whole system.
Why do insurers need insuring?
Think about a massive catastrophe, a huge hurricane hitting Florida, a giant earthquake in California. The potential claims could run into tens, even hundreds of billions of dollars. No single insurance company, no matter how big, could possibly afford to pay all of that out on its own. It would go bankrupt.
Okay, so how does reinsurance help?
What insurers do, including specialist underwriters like the syndicates at Lloyd's of London, is they take the risks they've accepted from customers, and they basically parcel up chunks of that risk and sell it on to other companies, the reinsurers.
So they're spreading the potential cost of a huge disaster.
Precisely. They are mitigating their own exposure. They pay a premium to the reinsurer, and in return, the reinsurer agrees to cover a portion of the losses if a major event occurs. This happens on a global scale.
And why is this secondary risk-spreading layer so critical for the financial system overall?
Because it protects the entire capital base that underpins global risk-taking. By spreading these potentially enormous losses across hundreds of different reinsurers all around the world, it prevents a single catastrophic event from wiping out a major player or causing a systemic collapse.
It keeps the system solvent.
Exactly. It ensures that the pool of capital available to pay future claims remains intact, even after a massive loss. And importantly, for the original person or company who bought the insurance, They only ever deal with their primary insurer. If they have a claim, they claim from the company they paid the premium to. The whole reinsurance mechanism operates behind the scenes, distributing the loss among the insurers and reinsurers.
That's a really clear explanation of a complex but vital mechanism. Okay, wow, we've covered a lot of ground. Let's try and pull it together.
Sounds good.
We looked at 5 key markets. The interbank market, focused on that critical short-term liquidity adjustment, now using safer benchmarks like Sonia.
Then the bond market, providing long-term debt finance, but heavily influenced now by central bank QE and QT actions.
Followed by the equity market, offering ownership stakes, where the health of the secondary trading is vital for raising new capital in the primary market.
Then the huge decentralized FX market, handling currency conversion, not borrowing, and really driven by speed and OTC structure.
And finally, insurance and reinsurance, managing and crucially spreading systemic risk across the globe. Understanding this structure really helps see the bigger picture, doesn't it?
It really does. And what's fascinating, I think, is to realize that the big financial institutions don't just operate in one of these markets. They're active across all of them, all the time.
Constantly juggling.
Constantly. They're managing their cash in the interbank market, deciding on credit risk in the bond market, maybe hedging currency risk from their international equity investments in the FX market.
Yeah.
It's this continuous, interconnected balancing act across all 5 areas.
And we also touched on the different ways prices move, didn't we? Some are quite sticky, others incredibly fluid.
Yeah, that's a key contrast. Think about your mortgage. If it's a tracker rate, the interest only changes when the Bank of England explicitly moves its base rate. That's a very direct institutional link.
Right, but then you look at the equity market or the FX market.
And prices there are flickering constantly, minute by minute, second by second sometimes, driven by news, sentiment, algorithms. It's a much more sort of collective psychological reaction to risk and opportunity playing out in real time within those decentralized high-speed structures.
Which brings us to maybe a final thought connecting some of these threads.
Okay.
We established that the shift to Sonia in the interbank market was about restoring trust in that foundational short-term lending, making it based on actual transactions. That seems vital for stability.
Yes, fundamental trust is key there.
But if, as you suggested, the long-term bond market is now facing potentially significant instability because of central banks unwinding the QT effect, how might that long-term instability ripple backwards?
That's a really interesting and frankly slightly worrying question. If liquidity dries up or volatility spikes dramatically in the huge government bond markets, which are often seen as the risk-free benchmark for longer-term investments.
Does that start to undermine the confidence that Sonia was supposed to rebuild, even though Sonia itself is technically sounder?
Exactly. Could serious stress in the long-term debt markets create such nervousness that it spills over and causes problems in the short-term cash markets? Could it lead to liquidity hoarding or counterparty risk fears, even with Sonia in place?
So the question really is about that deep interdependence. Can instability in one major pillar, like long-term debt, potentially shake the foundations of another, like short-term interbank trust, and send shockwaves through the whole interconnected system?
That's the complex reality of global finance. These markets don't exist in isolation. Shocks definitely ripple. And how those ripples interact, especially between the short-term money markets and the long-term capital markets under these new pressures, well, that's something everyone in finance is watching very closely right now.
A crucial question indeed, and definitely something for you, our listeners, to ponder and perhaps explore further. Thank you for joining us on The Deep Dive.